Hello and welcome to the Mutual Fund Show. My name is Neeraj Shah, and over the next 25 minutes, we'll talk about a particular type of mutual fund investing. Frankly, I think a lot of people over the last few days have drawn comparisons of what's happening in the world markets versus what's happening in India. And is there merit in trying to diversify not just within debt, equity, and gold, but also within geographies in which you invest in, which is India versus some of the others. Now, remember, we've done a couple of shows like this in the past as well, but it's always good to revisit this at a time when the world markets are painting a slightly different hue compared to the Indian markets. On the day when they also launched an NFO, which is similar, which gives you an option of doing that, which is investing in the global funds. Let's get in Aashish Somaiyaa of Motilal Oswal AMC to talk about the importance of this geographical diversification. If he does indeed believe it's very, very crucial, what percentage of a portfolio should ideally be in that? And what are the existing options and what is the new fund offer all about? Ashish, so good having you. Thanks much for joining in. We're talking about a month and a half only, but it was important to get you today. So good to have you. Tell us, Ashish, as somebody who is probably an investor himself, how much of an importance do you give to this geographical diversification theory?
I think it is definitely very, very important because, diversification by nature, by the very word, diversification means that you must have a bunch of low correlation or no correlation kind of assets in your portfolio. Now, admittedly, every once in a while when the world seems to be like it's falling apart. So at those times, it's quite natural that all assets do get correlated. But if you take a long period average, like, 5 years, 10 years, what you will find is that some of these funds, like say since last 7-8 years, we have a NASDAQ fund. And now, like you mentioned, we are coming up with S&P 500. Some of these funds correlations with Nifty 500 is as low as 0.1, 0.14, those kind of numbers. So my sense is that, this makes a lot of sense for people. And I don't know, what exactly is the percentage it should be, but my sense, a good guess is anywhere between 15 to 20% should be in these kind of assets to my mind.
So, sorry, am I getting this correct? You are saying that out of the total exposure, total equity exposure that a person has, 15 to 20% of that could be in non-Indian equities, be it direct or be it through mutual funds?
Yes, because for Indians, it's a new concept. But globally, if you actually look at it, it's not something which is alien to people.
Okay. Would you care to elaborate, Ashish? Are there trends that people globally have followed which Indians could look at as well? And how much do they help? Any thoughts, any theories, any data on that?
Yeah, see, look, the simplest thing that one can really think about is that, what does India do when vis-a-vis the rest of the world? So take a simple thing that, somebody has put this global emerging market as one particular block, and then you put the developed world as one particular block. But we all know that global emerging market, meaning it's just a haphazard clubbing. All emerging markets are not really the same. There are some emerging markets which are heavily dependent on commodities. There are some emerging markets which are heavily dependent on exports. India is also called an emerging market, but neither is export a big part of India, nor are we dependent on any commodity. In fact, we are reverse geared to oil as a commodity. And as an emerging economy, we are reasonably inward looking. So now when you talk to foreign investors, which I do a lot of, people who invest into India sitting out of London, Hong Kong and New York, they definitely have some sense of, what these correlations are and what are the drivers of each of these markets. So I think that we have a lot to learn from some of these international practices. And, the least that an Indian investor can do is to keep in mind that, what are the circumstances in which India does badly, and then prepare for those circumstances by having certain assets which will do well when India doesn't do well.
By the way, viewers, I have this data set with me, which shows how the Indian market returns have been from 2015 till 2019, of course, on each calendar year compared to, say, other markets. And just two examples that I'll take, for example, India and the US, if you just do a comparison, 2015, the Indian markets gave a negative return of 5%. The US markets ended positive 5.7%. 2016, it was a positive 1.66% for India. The US markets ended up higher by 7.5%. 2017, I think every market did reasonably okay, and therefore India and US were similar. And then 2018, Indian markets did better than the US market. So I think that's the other point that I think Aashish was talking about as well, that you diversify internationally, maybe you take care to see to it that your markets are not exactly in the same correlation as the other markets, so that you have a bit of a relief on either side. Now, Aashish, I heard you mention that you have this NASDAQ fund, which is 8 years. Before we get to the NFO that you guys are launching today, can you just tell us a bit about this fund? I mean, how has the response been from Indian investors? Have they lapped it up meaningfully over the last few years, or has it picked up in the last 1 year? How has it been?
So, we did that in somewhere in March 2012 is when it was launched. And I think the first 3-4 years challenge was more on the execution front. I won't say that investors were not looking at it, but I think that because we did an ETF, and ETFs have issues related to liquidity and illiquidity premiums and volumes in the exchanges, and plus of course not all mutual fund investors go about opening demat accounts or transacting with stockbrokers. So from that perspective, in the initial 3-4 years, we had certain acceptance or acceptability related issues. But I think it was a concept which was appreciated. Finally, what we did, I think, just a couple of years, 18 months back, what we did was finally to overcome this whole ETF challenge. We created a fund which would actually enable people to buy the underlying index. And from there on, I think that fund, if I'm not wrong, is now over a 500 crore size. Clearly, 500 crores by Indian standards is not a big number really. But in the last, I can say specifically in the last 18 months, there has been increasing acceptance. And I think that if you see NASDAQ 100 is a very popular index. It's about 47% technology and the new age kind of corporations which are listed on the NASDAQ index. So very high acceptance, and I think performance has been quite stellar since inception.
Okay, now let's talk about the NFO that you have come in, and Aashish also have an advisor come in. Tarun Birani should be joining us any moment to talk about his thoughts as well, to give our viewers both sides, or rather not just Aashish Somaiyya's thoughts on the NFO, because they are the ones who are launching it, but also an outsider's view on what kind of benefits and what kind of pluses and minuses might such an offering have. Aashish, can you tell us a bit about the new fund offer?
Yeah, so just like we had the NASDAQ 100, which we did in 2012, and like I said, NASDAQ is a tech-heavy index. In fact, it doesn't have financials. So from that perspective, I think S&P 500 is more, I wouldn't say old world, but I would say a typical broad-based large cap index. So two differences. One, I already pointed out that NASDAQ 100 is tech-heavy, and the other is, of course, NASDAQ 100 has across market cap kind of listings. Whereas S&P 500 is a 65-year-old index. I would put it this way, that if you landed up in the Indian equity market and you had no clue where to start, then a good Samaritan would kind of tell you, okay, go to the BSE and you start with the A group. That's where you would start. Now, instead of India, if you kind of landed up from Mars, you landed up on Earth and you had no clue where to start with equity as an asset class, then I would say the world's A group or the world's large cap index is actually S&P 500. Because it has the largest companies in the world. I mean, the smallest company in those 500 odd companies, the smallest company is about just under $2 billion in terms of market cap. And the largest ones, are well over $1 trillion in terms of market cap. And so, there's no active management out here. It's just an access product. I mean, what we are doing whenever we do this NASDAQ, S&P 500, etc., it's a very different practice from our the other side of our business, which is to do active management in Indian equities. This is way away. Here we don't take any active calls. We feel seriously that asset allocation and simplification of investment is something that we should run after. And that's why we do, I would call it more an access product. We are just enabling you to buy the S&P 500 index, because ultimately it's not possible for you sitting here to put 500 rupees or 1000 rupees or 2000 or 10,000, whatever the amount may be. It's not possible for you to put that money into US. So what we are doing is just building a pipe. We are pooling money out here. It's a SEBI registered mutual fund scheme. We are pooling money out here and doing nothing, just converting the rupee into dollars and just buying the S&P 500 index in its entirety. I think apart from this low correlation diversification bit, I think Neeraj, you were highlighting year-on-year performance numbers. And I think what is interesting to keep in mind is that while you're buying S&P 500 index, which is a diversified index across 11 sectors, what you're also doing is you're actually buying US dollar as a currency. And in the last 20 years, INR has depreciated annualized 2.5% year on year against the US dollar. And in the last 10 years specifically, INR has depreciated 4.5% year on year approximately versus US dollar. So apart from there could be a bad year in India and you are good that it's good that you are invested in the US market. That apart, if you have invested and the rupee depreciates, that adds to the return. So it's not just about asset and geography diversification, it's also currency, which matters a lot.
And that's an important point. If past performance is any indicator, then yeah, I mean, you would have invested and that would have been a natural hedge or a natural benefit that would have come into you. Well, actually, since we are on this topic, and we get in Tarun Birani as well, to first talk about this NFO and then we'll talk about the other aspects. But Tarun, good having you. Thanks so much for joining in as always. Yeah, Aashish Somaiyaa with us, and he was talking about this NFO that opens today from the Motilal Oswal stable. Have you had a chance to study this new fund offer?
Yes, Neeraj. I went through this product, and so I'll just quickly point out what are the challenges right now from a financial planning point of view for an Indian investor. So as we look at there are every year.
Tarun,
am I audible?
Yeah, Tarun, you are audible. May I just request you to first give us your view on this one, and then we'll get to the broad brush view of the whole global investing piece. But first on this NFO, what are the pluses? What are the minuses?
Yeah, so from a plus point of view, you are getting exposure to the top 500 companies globally, which is not available for an Indian investor as we speak today. And investors like Warren Buffett has always spoke about this particular S&P 500 index, that if you want to put your money and forget, I think this would be one index fund you should put your money. And because this index fund again has 40% of its sale outside India, it's in a true sense a very global fund. So if you ask me, anybody who is looking at putting his exposure outside India, this would be my first choice to look at it. So yeah, that is it.
Okay. There was some thoughts about how taxation, Tarun, might be different for this product versus others, and I would want Aashish to come in on that as well. But first, Tarun, to you. I mean, is that something that people should keep in mind?
So not really, because debt taxation from a 3 years perspective, you get the indexation benefit. So this fund will be rated more like a debt fund, and debt funds over a 3-year period gets the indexation benefit, and post that the taxation become minimized, and which is closer to the equity taxation now. So I don't think taxation is anyway a hindrance to enter into in this investment.
Okay. Aashish, you want to come in on the other finer points as well, because you spoke about the dollar exposure that person gets via this fund or any other fund. But since we are talking about the NFO first, let's just finish that and then we'll get to the other pieces. But also, somebody sent me a message about how the correlation of this S&P 500 index fund is very low to the Indian equity markets. And in that sense, you actually get a bit of a diversification in the truest sense. When India will do well, not necessarily that this fund may or may not do well, but when India is not doing well, you might have another fund or another investment which is actually doing well too.
Yes, I think that's the most important part, in relation to what Tarun messaged and Tarun mentioned, and also the message that you quoted from. Look, when you are investing, there are two things which should never happen. So for example, you have invested, most of us are invested in Indian equities. And then we have another investment, which we say that, okay, we are doing it for diversification. But then it turns out that that asset is absolutely correlated to Indian equity. Then there's no diversification which is going to work out for you. It won't work, right? The second is that if you have something which is exactly the opposite correlation, I mean, inversely related. Now, inversely related is also not going to work for you, because if one asset gives a positive return +1, the other guy gives a negative return -1, it cancels out each other and your return is 0. So you don't want something which is +1 correlation You don't want something which is -1 correlation. So you definitely want something like this, which is, close to zero correlation, which means that they are not going to move in tandem, and there is no pattern which is going to be so that is what actually results in diversification. So low correlation is extremely important for diversification. That's the first point. Second point is, like we mentioned, for a lot of us, at least some goals in our lifetime are definitely going to be linked to the US dollar, whether it is child's education, whether it is certain asset purchases, whether it is international holidays. There are so many things which our country imports, where there is a natural cost inflation because our rupee depreciates. So there are so many reasons why some of your goals or some of your planning must be in dollar terms. Even right now, just see what is happening. I mean, the turmoil started in the Western world. There is global selling, but the US dollar appreciates. Why? Because there is a flight to safety. So everybody buys US Treasury and US dollar. So that is something to keep in mind. And the third thing is that even if you are banking on the growth in emerging markets, you shouldn't miss one thing which Tarun highlighted in the beginning, that 60 to 65% of the sales of these companies is in US, but 40% of the sales of these companies is actually global. So look, if you want to invest in Microsoft, for example, and Microsoft, we all use their systems. Unfortunately, Bloomberg is a private company, so I can't quote that. But most of these large companies that we are using the products, even if you take Pfizer as a pharma company, you take Microsoft, you take the Amazon and the Starbucks and the McDonald's of the world, they are listed in the US, and they are part of S&P 500 index. So there's no way for an Indian to buy a stock of Coke, right? I mean, you have no choice. You have to invest in the US. So it's also a question of market access, which is what I was alluding to.
Okay. One final question, Aashish, on the show to you, and that is whether the tracking error or the taxation is different for this fund versus any of the other international funds available for somebody for international diversification. You think all of these funds would have debt taxation as a given?
See, it's very, very logical thing. The Indian government, see, in India, till 2 years back, investing on equity had zero capital gains tax. And since last 2 years, we have a tax of 10%, but you would agree it is still a concessional rate of tax. So it's very, very logical and very, very commonsensical that the Indian government or the Indian tax dispensation will give you a discount on your tax because you're investing in Indian equities. I mean, why should the Indian dispensation give you a discount on your tax if you want to buy US equities, right? So they're allowing you to do it, but I don't think they should be giving you tax concessions for buying US equity. I think that's perfectly logical. There's no reason to give you that tax benefit. But I don't think that when you are talking about diversification, I don't think that tax should be a consideration at all. In fact, Tarun explained to you why the calculation doesn't seem to be onerous. So he's right in making that calculation, and he's right that it doesn't have big impact. But I would go one step further and say that it would be foolhardy to even think of tax when you're thinking of diversification. There are so many years which you quoted in your table. There are certain years when US equity has a positive return, Indian equity has a negative return. So what tax are we actually going to calculate? Look, tax is a happy incidence. You have tax when you have a return. So if your starting point is going to be that I will not diversify because I have to pay tax, means you're not going to get that return in the first place, and you're not going to have that diversification in the first place. So I really don't think that when you are thinking of buying uncorrelated assets, there is a purpose behind buying uncorrelated assets, and tax just can't be the starting point for it. As far as tracking error is concerned, clearly it is our headache to ensure that we don't deviate significantly from the index. So that is clearly, there's no other performance measurement in an index fund other than to hold us accountable for faithfully mimicking the index itself.
No, I like that line. Tax is a happy incidence, and maybe people should keep that in mind. Let tax not be the determinant of whether or not you want to go for a product. Well, but Aashish, we wish you all the best for this new fund offer. And thank you so much for joining us and speaking to us about the merits of diversification, and all the best with the NFO.
Thank you, Neeraj. Thank you, Tarun.
Okay, now let's continue this conversation with Tarun as well, because we would love to get from Tarun ideas about why people should or should not do this. Ashish gave his thoughts. It would be great to get thoughts from Tarun as well, and then talk about what are the options available for an Indian investor, aside of course, the NFO that MO has started off right now. Tarun, sorry, you were getting into that point of the challenges or the challenges that an Indian investor faces when he looks at diversification. You want to elaborate on that?
Yes, I think many of the points have been already covered by Ashish, but at the sake of repetition, I will just give a broader perspective. But because when I deal with a lot of Indian investors or clients, I have always observed that we are too much into India. Everything is related with India. So anything happens here, the direct impacts get hit on your portfolio. And if I give you a quick maths around 2019, year 2019, the Indian market has delivered, say, 3-4% kind of returns. In the same year, US markets have delivered 35% of the return. Russia has delivered 44% of the return. Like this, the leadership is changing every year. Every year, there is a leadership change which is happening. So the point on diversification and low correlation is very, very relevant, very relevant. And as I speak on an equity thing also, why should I buy a Maruti versus why shouldn't I buy a Suzuki? Suzuki make all the royalty income from Maruti, as well as they have portfolio across the globe also. So if I, as an investor, I am getting into a global piece, why not? So that is one very strong case why I should look at global investing. Second, from a financial planning point of view also, there are a lot of requirements which we have observed most of the clients required for the children future. We all are traveling. Yes, I think at this point of time, talking about traveling is a little challenging, but we require dollars all the time. We live in a global environment. So we can't deny that tomorrow we may require funds anywhere. So it is important to have some asset base outside India. But from a again principal point of view, my suggestion would be not to go overboard more than 15-20% of your overall asset allocation into this asset class, global investing. That would be my suggestion. Apart from that, rupee depreciation, again, what Ashish has made a point, I have done this research around for almost 20-25 years, and it is clearly a pattern that there is a 4 to 5% rupee depreciation which is happening since 1990. Every year you are seeing a rupee depreciation happening. More or less the average of 4-5% is happening. So this is again an opportunity for an Indian investor to benefit from this depreciation. Yeah. So that also could be looked at. Yes, as we speak today, we are at a 76 rupees to a dollar today. It is quite possible there could be a volatility. But from a long-term point of view, if you're looking from a 5 to 10 year kind of time frame, I clearly see that rupee depreciation pattern will continue because there is an inflation differential between both the countries. So I don't see any reason why this pattern will change in future also. So that is again added thing. Also, the point of opportunity is absent in India. So we don't have opportunity like the tech companies of the likes of Microsoft, Google, Facebook. You don't have e-commerce companies like Amazon, Flipkart, the ride-sharing companies, consumer durable like Samsung, LG, Daikin, smartphone companies like Apple, Xiaomi, Samsung, pharma company like Pfizer, Johnson & Johnson. So all these diversification is available to us. So why should I limit myself only to India? Yes, it is very important to invest in something what you understand. And from that understanding point of view also, I feel that this makes a very strong case because this index, if I look at this index, has a 65-year track record. And it is one of the biggest index globally. And it invests in the bluest of the blue chip companies globally. So I don't see any reason why it should not be part of my portfolio.
Keep in mind what Tarun was saying, the top 10 companies of the S&P 100 index, Microsoft about 5% weightage, Apple about 4.7, Amazon 3.2, Facebook 1.9, Berkshire Hathaway Class B about 1.6, Alphabet A and C about 1.6 each. So essentially the bluest of blue chip names available, and you get an exposure through this. Now, Tarun, coming on the things that people should keep in mind. There are other options that are available in the market too, right? This NFO is one thing. Motilal also has the Nasdaq FFO, and we'll get to that as well. But there are a bunch of others. ICICI Prudential Global Advantage Fund, it's a fund of fund. I think Parag Parikh is a long-term equity fund wherein they invest 35%. Franklin India Feeder, Franklin US Opportunities Fund, DSP has a few products. Have you tried to look at some of these available products and which ones are better to invest in, which ones may not be as great? Any thoughts?
Yeah. So before I go into specific funds, Neeraj, there is one more important case. We need to understand that as a Indian investor, I have an option to invest $2.5 lakh under the liberalized remittance scheme, LRS also. So I can easily open a broking account and I can invest in dollars myself also. But from a retail investor point of view, I think it's a very challenging thing. But for the savvy investor, that as an option is also available. So I would also recommend that anybody who can invest directly and use that LRS scheme, he can buy this S&P 500 globally also, and that is available. The Vanguard S&P 500 ETF is available at a 3 basis point cost versus the Indian product will be at 50 basis point cost. So that also should be one thing which savvy and smart investor can look at. They can start look at investing directly in US dollars also. Yeah, but talking about the Indian diaspora, I think, yes, these are very simple products. So I would strongly recommend to go for more simple products. So in that simplicity thing, we have funds like index funds like Nasdaq fund available from Motilal. But there are a lot of active good names available in the market. Like there is a Franklin feeder fund, which has almost a 6-year track record in India. Again, it feeds into the global fund, which is again one of the top performing scheme in the large cap category. Apart from that, we have a fund from DSP, ICICI. So yes, quite a lot products available in the market. But if you ask me how the S&P 500 stands out, is because it's an index fund. It's again a very low cost product. As we speak today, it is available at 17 to 18% discount to the year to date peak level. So that is again an attractive level for anybody who want to invest for a long point of time. Yeah. So apart from that, there are a lot of products which are available. Like ICICI has a product which is dynamic enough to invest across the globe. So it will keep looking at opportunity dynamically. Let's say US is looking good, they can look at US. Europe is looking good, they can invest some piece in Europe. So they can keep moving the allocation across the globe. So that as a strategy also could be looked at, because the leadership is changing every year. So one may look at that kind of dynamic product also. Yes.
We are running slightly short of time. 2 quick questions, quick answers if we can. One, if the rupee depreciates, it's a positive for the person who's invested in these funds, right?
Right. Yes, it is. Yeah, rupee depreciation is a positive thing because that comes incremental to the overall to that fund returns. Yes.
Okay. Thank you. So thanks for that. That clarification was necessary. Ashish spoke about it, but good to get Tarun's view out there too. Last question, Tarun. Within all of these options available, because when people go online and try and search for options available, they look at multiple options. They might get a bit puzzled and they might go out and invest into a product which may not be optimum. Is there a product within the available funds in India which is maybe not as good? Because I heard you say that this S&P 500 index fund, the NFO, is arguably the best one available. Are there some, or is there some product which is not as good?
Come again, Neeraj, you mean to say talk about the other options available?
Yeah, from the options available, is there an option which is not as good as some of the others?
So I would not like products with very high expense ratios. Yeah. So there are a lot of global funds for the sake of global investing. They are doing investing, but they are available at 2.5% expense ratio. So without naming them, but I would recommend investors to look at expense ratio very clearly before investing in any of these products. And investing in ETF makes much more sense. Yes.
I get that point. Okay, Tarun, this was really good of you to join in this scenario, but thank you so much for taking the time out and being with us today and giving us your thoughts on all of these global investment options available.
Thank you. Thank you, Neeraj.
All right, viewers. So, well, Tarun Biryani clearly believing that this S&P 500 index fund, NFO, the NFO from Motilal Oswal Open today, is arguably one of the better options to invest in, simply because it tracks what is a really strong index with a terrific track record of performance as well. So do try and look at this NFO. Consult your financial advisor before you go out and buy that. And aside of that, there are multitude of other options available. Some from the Motilal Oswal stable itself, but others like Franklin India, Parag Parikh, as well as ICICI Prudential. So do try and do some research and try and bring about some diversification in your portfolio. Viewers, thanks for tuning in to this leg of the Mutual Fund Show.
The union to secure your future is here.